Good Saturday morning to you, and welcome to On the Mark. Along with Mark Papa, I'm Gary Byron. Mark is with Financial Resources Group in Glastonbury. You can find them online at www.frplan.com. That's F as in Frank, frplan.com. Write this phone number down, 860-657-8380. Again, 860-657-8380. Because I want you to call it. Not necessarily this second. I want you to hear the show. Mark's got a lot of great information this morning. This is a really fun and exciting show this morning we have for you. But maybe at the conclusion, give Mark a call. He'll be standing by. He'll be waiting to take your call. 860-657-8380. Mark, good morning. Great to see you.
Good morning, Gary. How are you?
I am not doing too bad. How are you?
Not bad. It's a weekend. I'm never bad on a weekend.
That's right. You are. I know you still come in. You take off. You enjoy your day trips. You enjoy your weekends in. You got Block Island and
I'll do Newport once in a while.
Newport. You've been there a couple of times, right?
Yeah. My weekends are going to be locked in with football for my son now. So I won't be going too far. So if it's not a practice, it's a scrimmage or a football game. And I'm very proud of my son's efforts. He's doing a wonderful job. So he's actually, I think he's going to be quarterback this year. Or at least one of the quarterbacks, which is great.
Good.
Yeah, he plays the part, and it's amazing to see. In my living room, he's constantly practicing his snaps and his form. He's just a dedicated. He's dedicated, so I'm very excited for him.
All right, way to go. Good luck this season.
Yeah, we should do well.
Before we begin, frplan.com, you really revamped your website. You want to go into that for a moment?
Yeah, we, believe it or not, and I'm getting a lot of leads from my website too, so I want to put a plug out there. If anybody has a younger, someone who wants to learn the financial business and get involved in the financial business as a financial advisor, I am taking on new entrants.
Wow.
I am getting leads. I have plenty of people to call and follow up with. The day gets away from you, so it's really difficult to chase people down who do come in through the website. But they actually, remember that 3 Little Pigs test I did?
Oh, yes.
So I started off with 3 questions, and people were answering the questions. And, are you confident about your retirement? Is your retirement plan working for you? Do you think you need to make some adjustments? And most people are saying they're confident because the market's up, but they also think they need to make some adjustments, like they're worried about potentially running out of money. So it's been working really, really well. So we revamped the website to be more client-friendly, more user-friendly. And when you go to www.frplan.com, there's a whole array of information in there. There's all these replays of all these radio shows, by the way.
Everyone. Going back to the first one back in
within
January,
reason.
February?
It might take a couple days for the web team to get it loaded up.
Okay.
There's information about Roth conversions. There's information about tax savings. We also have a button for estate planning. So anybody who is interested in learning about estate planning, whether they need a will or a trust, can go on under estate planning. And all you have to do is put your name. We're not going to harass you. It's up to you. You're an adult. You either want to die without a will or you want a will or a proper plan. But we will walk you through how to do that at no cost or obligation. So we have a digital law firm that we are called Estately that you can actually go on and do your will. Now, for our clients can go on and once a year we update their power of attorney. Because remember, I talked about how that power of attorney can get stale and the bank may just reject it because it doesn't have a notary, or they may not like the language, and I mentioned Social Security, forget it, they don't even work with your power of attorney. So, but people can go on there and update their will, create a trust even, and it's amazing. It walks you right through it. And one of the other things we'll do at no cost or obligation is help you fund that trust. So that'll mean we'll help you gather all your assets, all your bank accounts, your life insurance, all those little nooks and crannies. The one thing we don't do is help you get your deed changed. That's something that you have to do through an attorney, most likely, or through your town hall. But there is a system on our website that through that process, will actually allow you to put your house in a trust.
You could do this without an in-person meeting with you, just on your website?
Someone can do that on their own, but most of the time they're going to have questions. So we don't practice law. The law firm is Estately, and then they have tech support there that will help people. It's a licensed law firm in all 50 states. Now, if you feel compelled or you don't feel comfortable and you want to meet with a real lawyer, then obviously we have a network of attorneys that we have locally or throughout the state, actually. I have a group that I like down in Westport. I have a group over here in, obviously in the Hartford area, the 3-4 good attorneys that we love who are not just out for the money, but they're really out to help their clients. So we have plenty of resources for them. And then the third thing is if they want to start an estate plan, and not an estate plan, a financial plan, we have a third software that they can go into, and it's powered by a company called Planswell, and they use artificial intelligence, and it gives you the beginnings of a basic financial plan, and it spits out a PDF. I give you a call. We sit down for a half hour. We go over your goals, and then we go over the pros and cons of your estate plan and how to actually make that better, how to increase your income.
This is exciting.
Yeah, how to lower your taxes, how to make sure you don't run out of money. So those are the things we're doing, and it's all on our website. So we are literally a registered investment advisor on steroids, and I'm loving it. And they're healthy steroids, by the way.
I tell you, when we're done with the show, I'm going to head on over to your website this weekend. I'm going to check it out, Mark.
Yeah, www.frplan.com.
Today we are diving into a critical topic for many people: how retirees can safeguard their portfolios from concentrated risks in the stock market, especially in light of new economic warnings. I know that you're as an investment advisor with decades of experience helping clients navigate volatile markets. Mark, I'm so glad that you're here. Let's start with the big picture. Retirees rely on steady income and growth from their investments. So, what are the key concentrated risks in the stock market right now that people really need to be aware of?
Okay, so what prompted me to do this show today, Gary, was just reading the headlines over the weekend, reading what's happened on Wednesday, Tuesday and Wednesday, the market, into the Jackson Hole meeting, is very simple, is that the market has been dominated by 7 stocks. It bailed us out of 2023. Mm-hmm. Partially 2024, we saw broader participation in the market, deeper penetration into other sectors. But the bottom line here is the S&P 500 is incredibly skewed. And it wasn't just the Mag 7, the Magnificent 7, the Facebooks, Amazons, Microsoft. Right now, the biggest alarm that I saw, it was in Barron's, was an article that they wrote talking about, that it can't last forever. Nothing lasts forever. And I'm going to go through that. That's what the show's going to be about. I'm going to back it up. The bottom line here is 2 stocks so far this year have made up 55% of the return for the market. One is Microsoft, the other is NVIDIA. 55% of the S&P's return. Wow. That's 2 stocks. Now, that's insane concentration. There's 500 stocks in the index. There's many really very good companies throughout the S&P 500 complex and all sorts of different sectors. But for 2 stocks to make up that great of the return, I think is insane, which is why you saw stocks sell off. Like stocks like Palantir are selling off. They need to sell off. NVIDIA needs to sell off. Nothing can go forever. So, but the problem is when companies of that size, especially NVIDIA, sell off, it takes the whole market with it, okay? Because it's such a huge component of the S&P 500, and that skews the risk. Now, there's people out there, if you're in the Vanguard, VOO, and you're a self-directed investor, and I understand you think you're a genius right now because the market's going straight up, and you're crushing it, and congratulations to you. You're going to be fine in your retirement as long as markets cooperate. The issue becomes, what happens when markets don't cooperate? What does your portfolio look like? And if your portfolio is doing what the market's doing today on the upside, guess what's going to happen on the downside to most people, Gary?
Yeah.
What happens? They lose, right? And, again, if we go back to 2022, we have this thing called recency bias. The market's up, everybody's feeling giddy, everyone's happy. They're going to think the market's going to keep going. They have the fear of moving, FOMO, fear of missing out. And conversely, though, on the downside, the markets get a little shaky at these evaluations. People, panic and sell. So it's something that we have to be careful of. So I'm going to talk about how we diversify away from that risk. We still participate, but at the same time, we're not going to get hit on the downside.
Diversification, obviously a timeless principle. So a recent Barron's article titled "No Investment Strategy Works Forever, Not Even for the Mag 7," it highlights how the Magnificent Seven tech giants Apple, Microsoft, NVIDIA, Amazon, Meta, Tesla, I think, Alphabet, they have dominated the market, but they warn that no strategy lasts indefinitely. It also brings up historical examples of ExxonMobil. So what I'm hoping that you can do based on this is break down the main points from that piece, including Exxon's story. I think it's fascinating, but what does that mean for retirees, Mark?
Well, what it technically means, I mean, the leadership in the economy is going to change. Right now, AI is dominating the market.
Right.
And one other thing I do want to mention, speaking of NVIDIA and Palantir and all this, anybody who is listening today that has a concentrated stock position, it could be, I have a client that inherited Microsoft. Microsoft is up so much. Their account doubled. But this account came to me with a big tax trap, which I know how to get rid of now. But it was 80% of their account is Microsoft. It grew from $1 million to $3 million in a matter of 3 years, or some crazy number.
Cow.
It was like $1.2 million to $3 million. So that is a problem. So if you have concentrated stock risk like that, single stock risk, I would implore you to call me, go to my website, and we'll show you how to unwind that position in a way that is tax efficient, where you're not going to get hammered in tax at all. You pay no tax, and I may be able to diversify your account. Because I'll tell you, nothing lasts forever. So the ExxonMobil is the perfect example. General Electric is another great example. But let's just use ExxonMobil. Do you remember, Gary, back in the 2000s, late 2000, 2007, remember the whole peak oil? Remember oil went to like almost $150 a barrel?
Yep.
Well, that's when ExxonMobil was hit their peak in the S&P 500. We had high oil prices.
It was like $500 billion, I think, wasn't it? In 2007?
Yeah, and imagine back then. That wasn't that long ago. I mean, 2007 is less than what?
15 years
ago? Not that long ago. And back then, $500 billion was a lot of money. Today, $500 billion, we have stocks worth $4 trillion. I mean, it's worth, think about this. What's $500 billion anymore? That's just like a normal company, And they're talking about a behemoth the size of ExxonMobil. So just to think how magnified things have become over the years. But that is an area where oil was dominating the market, and then by 2019, Gary, Exxon dropped out of the S&P 500's top 10 for the first time in nearly a century. Oh, wow. And it was replaced by companies like Visa, Procter & Gamble. And by 2020, it was removed from the Dow Jones after 92 years. Okay, and swapped out for a company called Salesforce, which is another AI darling and another cloud darling that made a lot of money. But it just goes to show the dynamics of our economy. That you're not going to be able to chase these stocks. You're not going to be at a time when this one does great, that one does poorly. But at the same time, you have to understand that in this economy, if anything's doing too good, you're going to invite competition. That's pure economics. If you're making too much money, you're going to invite competition. Pure economics. And then eventually, if when things finally margins erode and new players come in, and you're not going to be on top for very long. No, it's kind of like this. It's the best analogy I'll make for the stock market was when the Kansas City Chiefs tried to three-peat. Right? They tried to win that third Super Bowl in a row. How hard is it to win?
It's hard to go back to back. It's hard to win a Super Bowl, but it's certainly hard to win back to back. Back to back to back, that's insane.
Insane. And that's my point. The analogy I'd like to make on the stock market, it's only so many times. I mean, if NVIDIA's up, I think 1,300% or some crazy number over the course of, I don't know if it's 2 years or whatever. Well, the bottom line is it's up insanely. It can't go on forever, okay? And all it's going to take is one little hiccup in AI spending, little hiccup in the economy, a little hiccup in, something is out there lurking that will pop these stocks. Right now, it's just a healthy sell-off.
It puts it all in perspective. I mean, it sounds like no stock stays king forever is what you're saying. The Barron's piece also mentions how just 2 stocks are dominating the S&P 500 right now. Which 2 are they? And hold on, why does that amplify the risks for retirees?
Well, the problem is that if you're in an equity portfolio, at least the ones I've seen built by advisors here. I'm not saying all advisors. Again, there's a lot of good advisors, so I'm not knocking advisors. I think advisors are so important. I just listened to a podcast about from a guy that was tasked by John Bogle at Vanguard.
Oh, okay.
This is a great story. And he was saying, well, Vanguard was the father of the S&P 500 index fund. So it was low cost, didn't do a lot of trading, very passive. And their advisors are charging their clients 0.85 basis points to manage their funds. And eventually the customers at Vanguard figured out, well, what do I need an advisor for? Because my fund's going up and he's not doing anything to attribute to that. So Bogle hired this guy to actually go in and figure out what was the value of an advisor and what are the things we need to do and what are the things we need to do for clients aside from financial planning and estate planning and income planning and all the things that real advisors do. He came up with a strategy to come up with assess the value, whether it's keeping on the market, managing the psychology. They came up with I think it was a fairly conservative number because you're talking about what the average advisor's rate of return would be was 3%, Gary, 3% in additional return just by working with an advisor through that study. So I thought that was pretty important. Right now, if your money is in a stock portfolio, you have a U.S. equity portfolio, maybe you have global diversification. I'm going to talk about that. You most likely have very, very high correlation to the S&P 500. So what I do is when someone comes in for the full checklist, they'll have 10, 12 funds. They feel nice and diversified, and I'll put them through a Morningstar, and I'll put them through this thing called the correlation matrix. It looks like the old Qbert video game. Remember the Qbert video game with the cubes?
I do.
Or it looks like the old maps that, used to get you from like Akron to, Nevada.
The triptychs.
The triptychs. Yeah. It looks just like that. But I will show you on a 9 out of 10 times that your portfolio all acts the same. Everything is very highly correlated because we haven't had a lot of volatility, Gary. So we don't have a lot of volatility. You don't have that. You have two types of correlation. You have negative correlation and positive correlation. And then you have zero correlation. But you want to make sure that your portfolio is diversified. When 7 stocks dominate the market and 2 companies are 55% of the return, you've got a problem.
Folks, you are listening to On the Mark along with Mark Papa. I'm Gary Byron. He's with the Financial Resources Group. They're out of Glastonbury. Check out, and I haven't done this yet. I just learned just a little while ago, they've got a brand new website at www.frplan.com. It is extremely user-friendly. I am going to check it out when the show is over. Also, 860-657-8380. I'm going to repeat that, but that's an important number. I want you to write it down now because at the end of this show, I want you to call it, and there's very good reason. I'll give it to you again. 860-657-8380. Look, Mark, I mean, these are great points about not putting all your eggs in one basket. You should always diversify. You told us that week after week. But you
have to diversify the diversification.
Well, right. And there's a whole other layer.
That's the problem. It's not as easy as it looks.
No, but you've mentioned this in the past. There's another layer, though, to this economic picture. A recent Market Watch article quotes Meredith Whitney, famously known for, if you remember, folks, calling the 2008 financial crisis that we were just talking about, warning about a bifurcated economy as a new problem for the U.S. She says this could spell trouble for the stock market. All right, I don't know all. This is why you're here. I only know a little bit about this. You know a lot about this. Explain what she means by what's that bifurcated economy and how does that connect though to the risks that retirees face right now?
Well, I mean, this is an interesting thing because the consumer economy is a big part of we're a service economy. What is it? 70% of the economy is services.
Yeah.
And that means you need strong consumers, right? You need strong consumers. Now, as of today, we've had a lot of change in the economy. We've had tariffs. Which I think have created a lag in the economy, a lag in spending, a lag in decision making from businesses. Things are starting to smooth out. So I think forward looking, I'm pretty excited. However, you also have had consumers that's affected consumer behavior. You've had immigration. Well, I don't call it immigration. I call it illegal immigration. I'm not afraid to say that. People being deported. That takes away from economic growth, essentially. because those people were spending money. The sad reality is they were spending our government money in many ways, getting those free debit cards and cell phones and hotel rooms, which is a stimulative in and itself. But that needed to adjust. Those are bad economic things. And on a good way, what she's basically saying that bifurcated is that 50% of American households, particularly lower middle income ones, are struggling, effectively living through recession-like conditions. Now, during inflation has come down.
But not all that much.
Not all that much, but it's come down enough, but it's still not enough for your average person to get ahead. So the only way that we're going to see any type of forward-looking economic growth is we're going to need to continue to have we have a fairly tight jobs market, but it's very spotty. It's spotty. There's, 500, I think sometime like 500, I don't know how many jobs, huge amount of job openings. And in certain areas, there's no hiring going on. In other areas, there is. So it's kind of an interesting thing. But the economy, I'm not saying it's fragile. I think that we're looking at, a fairly interesting forward-looking way with the tax cuts and the Jobs Act. So I think the backward-looking economics, we're waiting for what was going to happen with Trump and the big beautiful bill, the tariffs, and smoothing that out. I think eventually, we're going to be okay.
Should retirees be cautious?
I still think retirees, if you're retired, you always need to be cautious. You don't want to go out on a limb, and you actually want to have your portfolio stress tested to see how risky it really is, especially if you're in bonds. I mean, yeah, when rates get cut, bonds do well. But the bottom line is the bonds are just as volatile, could be just as volatile as stocks sometimes. And that's something that people need to understand, that you need to do a better job, or advisors need to do a better job protecting their clients from market risk, not just trying to get them the highest rate of return to bump up their fees, because that's what they do. Yeah, they take on more risk than the client even knows, and more than the advisor knows half the time, because they're getting their 1% and they're trying to pump up their 1% so that they can get a bigger paycheck.
Mark, this is why people need to sit and chat with you.
It's wrong.
Speaking of those struggling households that you just mentioned, recent data shows that around 57% of Americans are still living paycheck to paycheck here in 2025. That's up from previous years due to lingering inflation and high costs. So that said, how does this tie into retirement planning, especially in this bifurcated economy? And I mean, we've got about 4 minutes. What steps can these pre-retirees take in order to avoid that trap post-retirement?
Well, I think the big problem with that, Gary, is if you're retired and half the country is living paycheck to paycheck, chances are you might have a child or a daughter with grandkids, or somebody who's living paycheck to paycheck too, trying to make ends meet. I know lots of my clients are babysitting their grandkids because their child, they can't afford, they can't, whether they're retired or just nice people, they can't afford daycare. So they're not making enough. They're scraping by. So, I get a lot of retirees who want to gift money to their kids or help out their kids, and because they have a nice nest egg. If you have assets, you're fine in this economy. It's the people without the assets. That's the bifurcation. Those are the people that are struggling right now. They have nothing to fall back on. I mean, I have a client, he's really funny. He always says, my kid, he doesn't have 2 nickels to rub together. I need to get some money. Got to help him out. He doesn't have 2 nickels to rub together. Never has, never will. He's hysterical, but, he helps his kids out. But I see that all the time is that parents, they can't get bank loans. Their credit scores are shot. Maybe it's from a divorce. Maybe it's just from some bad financial decisions. Maybe it's from student loans. But by nobody's fault, sometimes it's their fault. Other times it's just external things. So you have to be able to protect yourself from that. You also need to be able to protect your portfolio from market volatility so that when you do have those emergencies, you have that place to get that money. It's not a big deal. You're not going to get whacked with a big tax bill, and you could pull it out. And then in a down market, when you need your income, you pull it from that safe bucket so you don't have to sell your account out at a low. Because if the market's down 20% and all of a sudden you have to take money out to pay bills, or you take money out because you have a required minimum distribution, which is something we can also help you eliminate. Then what has to happen is you're locking in, you're taking that money out when the market's down. If and we like to smooth that out over 12 months so that you don't fall into that
Sure,
trap.
right.
But the bottom line is you take that lump sum in a down market, you're locking that loss in forever. That kills the future returns and future cash flows of your retirement. So you have to be so careful what you do. And that's why you need to work with us, because we help you prevent that from happening. And every client's got a nice, healthy emergency fund so that they don't have to harm their growth assets.
I got 2 minutes. Final question. Why is global diversification so particularly important for retirees in this particular environment?
Well, I think it's a great idea because if you look at the beginning of the year with all the tariff talk, when the market sold off, a lot of money went over to the European markets, overseas markets, because they were undervalued. Mm-hmm. Keep in mind that most of those overseas companies are like Louis Vuitton or mining companies or consumer-driven type companies. So you're not going to get the high-tech, high-growth returns out of many of there are some of the European stocks. So it's a more value-oriented, sleepier, dividend payers, more conservative companies, well-established. And I think that's a great place to buffer your portfolio in terms of that. And also emerging markets, where everyone thought emerging markets were going to do terrible. Emerging markets did very well in the beginning of the year. Due to the decoupling from China and a few other things. So they did better than were expected. And although the dollar got weaker because everyone thought the dollar was going to be stronger, but you can't have a strong dollar when you're borrowing that much money to fund your budget. So in the deficit.
Very good.
Diversification.
Yeah,
key.
I mean,
true diversification. Not I have 12 funds all doing the same thing, which I'll show you, especially at certain institutions. I could tell you that they use the same fund family. That same fund family pays the firm millions and millions of dollars to make sure their advisors sell those funds. And I could say it's American funds. And I won't say the broker-dealer, but it's disclosed on their website, which is deep into the weeds. If you have that certain firm, chances are you're getting Franklin funds and American funds. So you've got to be super careful what you do.
Diversify. If there's anything that the overwhelming sentiment on this show.
And protect your money.
Folks, if you like to repeat this show, if only you caught some of it, you like to, you came in late or had to leave early, or any of the other episodes that we have done for, oh my goodness, maybe 7-8 months, head on over to www.frplan.com. And schedule a meeting with Mark or zip him over a quick email from frplan.com. You can call him up and schedule that at 860-657-8380. Again, 860-657-8380. Financial Resources Group is out of Glastonbury. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next weekend, have a good one, everybody. So long.